Carl, let me turn to you in light of what Rick just reported. What is your view on that? I mean, the market does seem to be swallowing up these large slugs of issuance very comfortably. And as Rick points out, well, it does it until it doesn't.
Sure. Well, it seems to be taking it in stride for the moment. But as you cross into record large auctions, it does raise some concerns about where the ultimate clearing price will be. And I know you wanted to talk about housing, so we can go there. If we look at, where a 10-year Treasury yield is trading or settling, that's a key driver of where mortgage rates are going. And I think a new reality is setting in with home buyers that we're not going to go back to those pandemic lows anytime soon, given the very soft landing in the economy, persistent inflation pressures, which are trending lower, but taking some time to move there. And that means elevated mortgage rates with a 7 is the first number as opposed to 2 during the pandemic. Housing affordability, of course, gets squeezed considerably by that. By some metrics, it's housing's the least affordable since the early 1980s. That puts a lot of pressure on the sector. Now, because of the supply chain disruptions during the pandemic, I think we still see a lot of activity in the pipeline. So if we compare kind of under construction to completions, we see that there's still a lot of residual activity. But at some point later this year, that starts to rebalance. And for example, the construction sector might be a less reliable contributor to employment gains. And of course, there's lots of knock-on outside of the construction sector into specialty contractors and retailing, furniture, et cetera, et cetera. So there could be a compounding effect there. But to Steve's point on the inflation front, it's inflation in 3 acts, or disinflation in 3 acts, I should say. Act 1 was goods disinflation. Bravo, we've gone full circle. Act 2 is the shelter inflation story, and we're still in the middle of that. But these, the trend has been lower, and home prices are an important driver of the direction of shelter inflation. So my own team thinks that we'll see further disinflation on that front over the course of the year. Of course, a big chunk of the CPI, so it absolutely matters.
All right, Steve, I'm going to give you the last word here. Carl points out that maybe there is some disinflation in housing, but you've still got very strong demand for housing. New homes are selling really very briskly, and that would tell you that demand is high, supply is not that great. So where is the relief that needs to happen in housing and shelter costs to bring inflation down?
Yeah, so I've become a little skeptical that that's going to happen. I think if you lower prices, you bring a whole bunch of people back in. You lower the mortgage rate, you bring a whole bunch of people back in. There's all kinds of supply that's off the market right now. That could come back into the market. And that's
off the market because people don't want to trade
their 3% mortgage for a 7% mortgage. They might trade it for a 6%. That could have some impact. But the decline in housing inflation will be something that's much more mechanical in that rents have come down, and that's one of the ways that they impute housing costs. I'm even wondering, Tyler, if the Fed needs to begin to look past the housing inflation in terms of setting monetary policy, because I don't know how much it's related to what they're doing. Of course, they have, as Goolsbee described it last week, he said we have one tool, it's a screwdriver, and we tighten or we loosen, and that's it. And of course, some people drink that for breakfast.
All right. All right. Thanks screwdriver. All right. Thanks very much. And Carl Riccadonna, thank you as well, Steve.